Welcome everyone, thanks for coming tonight. We just made it just before the big river of rain. That's what they say when in San Francisco. But we're blessed, you see, we'll be protected because we're crypto fans. So welcome, and everyone's really looking forward to this panel tonight because I think it's going to be an interesting conversation with three leaders from the industry about STOs. So I'm going to pass it over to John. But first of all, Colleen is hosting tonight. She is an attorney at Shepherd Mullen, a structured financial partner at Shepherd Mullen. So if you've got any queries or questions after the event, please grab her. And also there's some of her cards out on our table at registrations. So I'm going to pass it over to you now, John, and you can get the panelists to introduce themselves.
Yeah, sounds good. Yeah, ladies first. Let's have all of you introduce yourself and go ahead and start calling.
Okay. Hi, welcome everyone. Nice to see a good turnout tonight, notwithstanding the river of rain that's coming apparently. So yes, Colleen McDonald. I'm a partner here in the San Francisco office of Shepherd Mullen. I have been working in the securitization area for 20 plus years. Started back with autos and credit cards and Robert, and now doing a little bit more with FinTech clients, but still a lot of the sort of tried and true securities products, the asset-backed. But I'm fascinated to hear from the guys tonight. It's like it's three leaders in the industry and me. That's so welcome and look forward to talking to everybody tonight.
Thank you, Colleen. Good to see you again. So I'm Jamie Finn, President and Co-Founder of Securitize. We offer a primary issuance of digital securities, and then we have a compliance protocol for managing those securities as they trade on secondary marketplaces.
Jajah, CEO and co-founder of Harbor. Similar to Securitize, we're a software platform for primary issuances, and then we're a blockchain protocol to make sure they compliantly trade every time, everywhere. And then we also have registered reps who work with the local broker-dealer, and we also do some distribution. I think it's interesting the asset-backed securities background. I think at some point we should address that in the panel. I think that's a particularly good application of tokenized securities. In fact, our in-house counsel did 10 years of securitizing asset-backed securities in Circuit Austin. She got hired because she gave us a great presentation on how we should be tokenizing ABSs. Her name's Liz Kang. She was at Circuit Austin for a decade. Okay, and she gave a great presentation on it, and we said, okay, that's awesome, you're hired. So looking forward to it.
Good story.
Hello, my name is Mason. What our company does is we help issuers of digital assets comply with the relevant regulations when it comes to banking, securities, and tax laws, whether it's domestically or globally. We help them comply generally on a jurisdiction per jurisdiction basis. So we help them treat their investors uniquely based on where they're coming in. Yeah, that's what we do.
Which company?
TokenSoft. I'm with TokenSoft.
Good job, good job. I'm John Boitnott. I write for Inc. and Entrepreneur. Been doing that for about 5 years. Been working with Temo for the last year and a half doing the moderating for some of these panels. Also do PR and marketing consulting. So let me know if you need content or anything related to PR. All right, so let's just sort of, for those people in the audience dipping their toes into the securities waters for the first time, let's talk about what are they? How about that? What makes them so special?
Everyone's familiar with Bitcoin. Bitcoin is a asset on top of a blockchain. At some point, people started putting a Bitcoin address on a website, raising money, and giving out their own coin that represented their company. And it became a very popular form of fundraising. Over time, people learned that that was illegal to do, and they learned about securities laws. The industry learned over time that that asset that they were issuing was to be treated as a security. And over time, people are now issuing a secure or a coin that is backed by things like real estate, things like LP interest in funds, and we're seeing more and more assets. So security tokens, digital securities are digital assets that are generally backed by some sort of entity, and they can go trade, settle on the blockchain.
I should also ask, what are some of the differences between the different asset classes there? Are some easier to tokenize earlier, later? Go for it, John.
Sure, the different asset classes are mostly the same ones you get in traditional finance. There's real estate, there's companies or private equity, there are asset-backed securities. I think what's sort of interesting, particularly probably for some people in this crowd, is you start to get either these digitally native assets or new types of assets that live only on the blockchain. So you can create revenue bonds or revenue classes of equity that are getting a share of the revenues coming off of these blockchain protocols. How easy or hard it is to tokenize really has to do with what are the rule sets, and the rule sets depend on the securities laws underlying the type of security. So a REIT is going to have a different set of rules and look differently than a fund, a GP/LP structure. Those are going to look different by country. It also depends on the tax rules and the other things that you're trying to control for. I think if you step back, what are all the things that you have to look at when you're tokenizing a set of securities is all the rules center in around the who, the what, and the where. Rules around who the buyer and seller can be, rules around what that capitalization table or ownership structure needs to look like, and rules around where the trade can occur.
Thoughts, Jamie?
No, I mean, I think Josh does a great job outlining it.
Okay, Colleen, you?
Sure. Well, I'll just back up a little bit and talk about historically what was going on with the ICOs. I'm sure everybody has lived through it, but for a long time there was, I think, a hope that the ICOs, the coins, could be offered without having to be registered under the securities laws, right? And so I think that the securities regulators got out in front of it pretty quickly. I mean, there was probably about a year and a half of a whole bunch of ICO offerings, and the securities regulators came out and said, no, that's not going to happen. It's a security. And the reason why it's a security is because of the Howey test, which is a Supreme Court decision from the 40s that has a very sort of common sense approach to what is a security, what is an investment contract. And it dealt with orange groves in Florida, not swampland, but orange groves. But the basic takeaway is that it's not the asset that, or the asset that you're looking at that determines whether or not something is a securities or an investment contract. It's what you do with that asset. So an orange grove isn't in and of itself a security, but when you offer to allow people to participate in the profits from that orange grove, then it becomes a security. So with that sort of that fundamental basic test, when you apply that to ICOs and what was going on with the ICOs, because there was an expectation or a hope of profit from the efforts of a third party, which is the party that's developing the enterprise that's issuing the token, that became, it was pretty clear, I think, for the regulators anyway, that was a security and had to be registered or had to find an exemption from the securities laws in the United States. So that's the background.
That's great, yeah, good. You guys are obviously helping companies tokenize. What are some of the biggest problems related to that whole ICO process that you're seeing?
Well, I mean, I think that one of the biggest problems we see is when people think of it as a good way to raise capital in an ICO. And so we deal with a lot of companies that come at it and they're like, oh, it's like an ICO, we're just gonna put it out there, raise a bunch of money, and it's gonna be great. The reality is these things are complicated. They require, real securities lawyers to be involved. Putting together the offering documents is complex. And then taking yourself through the whole process will take, it's not a few days to get one of these things out there. And so as companies go through that process and understand how it all works, that really, they'll start to understand the complexity of what they're doing. So that for me is the biggest difference in that market.
You have any thoughts from you guys on that?
Yeah, I do think it's the getting out of the ICO mindset. So there was a time where you could yell token, 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 and hot dumb money would just rain from the skies. And for good or for bad, those days are over. So it's much more about the investment fundamentals. Tokenization is a great marketing angle. You're going to be able to talk to anybody and get anybody to look at it. It is a great format, particularly for overseas investors who want to be able to invest through a software platform. They don't want to be faxing documents or talking to some attorney a continent away whose language they don't speak on a different time zone. And the liquidity is very attractive. The ability to get in a smaller check size, to be able to trade it, to structure it, to get margin loans against it, to use things like DYDX or Dharma or Blockboard or some of these other great technologies. But fundamentally, at the end of the day, it's all about the investment. So if you have a crap investment, you tokenize, you have more liquid crap, and any parent of a young kid knows that's a bad deal. God, you guys are a tough crowd. I'm going to end on a low note.
I think the biggest problem today is that there is no infrastructure for these securities, and the problem is that we've had the traditional markets with traditional infrastructure, and that's been very well baked and has been working well for a while. But what we're doing now is we're completely rebuilding this infrastructure from the ground up on blockchains. And so I think one of the problems is as we're building up, we're realizing a lot of those core pieces that make the financial markets operate smoothly today don't really exist. So it's sort of like we're building the infrastructure underneath us as we move forward. And I think that's one of the challenges with the space is we did move really fast last year, but we're realizing there's a lot more pieces that need to come into place before this can become a real market.
You're saying kind of we're in the proselytizing phase. Who said that? So one of you guys said
We were
that.
chatting earlier.
Yeah. For sure. You guys are just laying the foundations as you go. So is there a time or a preference or when a company's looking to tokenize that they should want to or need to absolutely hook up with a broker-dealer or exchange, or what are your thoughts on that?
So issuer does not have to use a broker-dealer. They can sell their own securities. It's a question of if they think they've already got the investors largely lined up, they probably don't need a broker-dealer. They may still want one for some additional expertise, but if they need distribution, if they need to get this out in front of investors, then you need someone to go sell it. Most investments are sold, not bought. Somebody's got to go out there and actually counsel somebody and sell it to them. What I do think, if you're a company and you're going to tokenize equity in your startup, particularly if you're like a blockchain company, you ought to be. You ought to be talking to the issuances platforms early and figuring out, do I need a broker-dealer? Can I do it myself? What all's involved? What are the legal issues I got to think about? It is not rocket science, but it does take some forethought in terms of, okay, do I want to sell this widely and let it trade widely? Okay, do I really want to have strangers on my cap table with access to my books and records, and how can I limit that? What sorts of corporate rights or pref rights would I give them or not give them? Do I want to have a restricted group that can trade? Okay, now I feel more comfortable about having these folks on my cap table. On the other hand, I'm restricting liquidity. How important is that to how I sell? If I do a Reg D and I'm raising a lot of money, the ticket size is really high to get in. If I do a Reg CF because I want to drive engagement with a bunch of retail investors, I can only raise $1 million, of which a lot of it's going to get chewed up on fees. And then I got to publish my financials for 3 years. Maybe I don't want to do that. If I'm a esports team, I probably really want to look at a Reg CF because it's less about the capital I'm raising, it's more about getting an ownership mindset and driving some real fan engagement with my team. If I've got a successful Series A and I'm raising a Series B, then it's about tokenizing it to enable liquidity amongst a much more limited group of investors and trying to get outside of my traditional channels.
Yeah, I mean, we see, a variety of different companies. I think it's a product that suits Series B companies. It's not really a great fundraising mechanism for a pure startup. We see a lot of real estate projects coming along as well. And then, we as a company have done a lot of funds. So I think for the reason I got into this space in the very beginning was because a tokenized VC fund just made sense to me. As an investor, and I was like, oh, this makes a lot of sense because I don't normally have access to that asset class. And so, in that process of learning and getting that out there, I think that's a really great type of product in this space.
Great. One
I wanted to go to possibly talk about something that Colleen, you and I talked about that's kind of about these three guys, so it's going to be a little unorthodox, but so help me out here. But so we talked earlier about sort of we're laying the foundation as we go, and so all right, TokenSoft is starting its own broker-dealer kind of exchange type of a thing, right? Or is associating it, so how does that work? And then also, before you talk, Securitize is doing something sort of similar as well. So let's just sort of hear about that. And then I wanted to get your sort of thoughts on what that's about too, Colleen.
TokenSoft announced the purchase of interest in TokenSoft Global Markets. And that's all I can say about that right now.
Okay, great. And then,
So in fairness, we do not have a broker-dealer. We don't raise money. We don't participate in that part of it. We don't have that type of business model. So it's a very different approach. We're just a pure software as a service business.
Okay.
Harbor, maybe. Harbor.
Yeah, we're primarily a technology platform. We do have several licensed brokers who hang their hat, or when they're selling, they're doing it as part of a different broker-dealer in the Bay Area, but we are not ourselves a broker-dealer, nor do we own one.
Okay, got it. All right, Colleen, our idea of cradle to the grave, do you think that it's not for real then? Or just to talk about what I mean when I say cradle to the grave as an idea.
Right.
Getting controversial here, oh my God.
Well, I think that one of the issues that I've heard Jamie speak of before, and I'm sure the other, that Mason and Joshua also agree, that liquidity is a problem, right, in the market. And
That was going to be my next question, but yeah.
right. So if you think about how do you solve for that, I think that if you have people to go out and sell the product, you educate the market about what's out there. I think that some of the securities exemptions are great for trying to democratize and bring more, more the smaller investors into the process. So they want to buy a piece of a VC fund. They can never do that if you had an accredited investor standard, right? You have to get in, you have to have so much money to get in on the investment. So I think that securities exemptions, and then the fact that some of the platforms that are out there that are bringing this compliance, so it makes it really easy for a company that wants to go out and raise money to comply with tax law, to comply with other securities laws, et cetera. For them to have an exchange, I feel like that's a natural progression of availability for the market and bolstering liquidity.
Yeah, sure.
Yeah, I mean, so the exchanges are coming. We've already seen Open Finance, which is a marketplace, not an exchange, here in the U.S. launch. They have 3 or 4 tokens trading already. They're going to be adding a bunch more shortly, and then T0 has actually launched as well. And so one of the things we talk about is really a continuum of liquidity. So exchanges are definitely one place, but as Josh mentioned, companies like Blockboard or Dharma offer debt. Debt is another type of liquidity. Taking out loans, and so there's all sorts of this kind of continuum of liquidity that's enabled through this, and I think that's one of the most interesting parts about it, is you can have this securitized asset and then decide to trade it, take a loan against it, maybe sell it to somebody else directly. So there's a lot of like new things that you can do very easily, but like instant settlement, not 40, 50, 60 days with like 15 people involved. It's literally, I decided now, I go to a website, and I can do it.
I think it's worth clarifying how we think about this blockchain and liquidity. Liquidity comes from buyers and sellers. And just because you digitize a share in a company doesn't mean you have liquidity. If people don't want to buy it or nobody wants to sell it, you're going to have zero liquidity. What it's about is 2 things. One is these software platforms that allow you to syndicate more widely. You lower the check size, you put more investors into a vehicle. The lower the check size means more people can trade in and out, and they're going to do so. Second is, and more importantly, the blockchain aspect of it, is that you're removing all the friction to trading. There are, I guarantee you, private wealth managers at Goldman Sachs, and JP Morgan, and elsewhere that having gotten their clients into these alt investments, these private securities that are hard to trade or get out of, they had a client that wanted to get out. It takes them months, sometimes years to get them out. They're phoning, faxing, and emailing a limited group of counterparties. When they do find somebody, It's 2 to 3 weeks of trading red lines. It's 10 to 20 grand to the lawyer. Good for the lawyer's kids, not good for the investors. Tough crap. And then finally, you take a big hit on the valuation, the illiquidity discount. And the numbers I hear the most often for high net worth individuals and credit investors is 40 to 60%. So if you had a $150,000 investment, you're lucky if you're walking away with 75 or 80 grand, 6 to 9 months later. It's not that you tokenize it and now that stuff's trading in milliseconds. It's not going to happen that way. If you look at the investment that Harbor has live right now, it's $21,000 a share, $21,000 per tokenized security. It's a single asset private REIT, you're investing in a building. So at a $21,000 ticket size, people are not trading that in milliseconds. At a single asset, you actually have to understand the asset and the market. That's going to trade like, looking around the crowd, I think there's maybe 1 or 2 people that are going to do this reference. It's going to trade like the old NASDAQ pink sheets, back when they were actually printed on paper. Dan Cressman's nodding his head, he knows what I'm referring to. Those with the gray in their hair. But what becomes really interesting is other assets will trade more quickly. So if we think of tokenized equity in a blockchain startup, tokenized equity in an esports team, that's going to start to trade more rapidly. That should trade on exchange. Stuff like tokenized REIT, most likely probably trading over the counter. But then what becomes more interesting is a world in which you start to tokenize a lot of assets. You can all think of the blockchain as like, for the technical people, it's like the DNS of assets, the domain name system into individual assets. Now you start to get some really interesting things. So imagine a world in which, I'll use a real estate example, you start to tokenize on an individual building basis, Class A office around the greater New York area. I can then buy a token in an individual Class A building. Okay, that's kind of interesting, but I gotta know that building, I gotta know who the leaseholders are, there's a lot of due diligence. It's not gonna trade that rapidly. It's gonna be real estate professionals. But now, I've tokenized a bunch of these buildings. So I buy 1 token from each of the Class A buildings downtown, and I can use set and create 1 token that binds them all up. I now have a micro custom ETF. I have a downtown Class A ETF. You cannot do that today, period. I can do the same for Midtown, the same for Uptown, the same for the boroughs. Using DYDX, I can go long downtown, short Midtown. Using the Dharma protocol and Blockboard, I can very efficiently get loans against those assets. Using MakerDAO, I'm getting a margin loan in DAI in a stable coin. I think tokenized real estate becomes the gold standard for multi-collateral MakerDAO contracts because it is the most stable asset you're gonna get out there as collateral. You start to be able to do things you couldn't do before. People talk about tokenizing individual homes. That is way down the road. These platforms, the ways in which we're making the legal documents cookie cutter, drive a lot of cost and friction out, but there's no way it's economic to tokenize a $200,000 asset. Period, end of story for a while. But now there are folks who own lots of these residential homes. You start to batch up 100, 200 of them at a time, call it anywhere from $20, $50 million worth of assets, and you tokenize it. I can now make a bet on a zip code level on residential real estate. I live in Marin, I still rent because I wasn't able to get in at the right time and the value of the house I rented doubled. I still can't get in unless Harbor hits, right? But I would have bought up something that tracked the residential real estate in Marin because that I knew was the right investment and it would have hedged my risk as a renter. Similarly, if I bought a home, I can hedge my risk or lay it off with other instruments against it. If I'm a home developer and I'm going big in an area, I can hedge my risk, I can increase it. If you think about what was going on with HQ2 for Amazon, and where's it going in, where's it not, is it still going to Queens, isn't it? You have seen some really interesting spikes in trading in logistics and residential and other buildings around those announcements. Fundamentally, what we're about is unbundling and rebundling. Unbundling things into smaller bits, smaller check sizes that we call tokens, allowing them to trade freely so that you can rebundle them in interesting ways to unlock financial possibilities that you couldn't before.
Okay, so that seems to be, but what this is all about is unlocking more liquidity, right? So over the next 2, 3, 4, 5 years, what needs to happen in terms of how do we access liquidity?
I think we can still probably point to how the infrastructure still isn't there yet. And I think obviously if it was, then the traditional players in the market would be able to plug in. But I think 2 things need to happen. The infrastructure needs to build out. So we do need those traditional pieces of the infrastructure to exist so the appropriate people can plug into the network. I think the other thing is the market still isn't there yet. The market doesn't exist. People don't know what security tokens are. They don't know why they're interesting. And I think that will probably take about 3 to 5 years to come to fruition. But yeah, I think those two things need to come about for this to work.
Thanks, Mason.
Yeah. Let's get thoughts from all of you guys on that. Barriers that currently exist, what needs to change?
Yeah, I mean, so I think, you know, the one of the like infrastructure pieces that's missing is a custodian product that makes sense for digital security, right? So all the products in market today have been designed for crypto, like hardcore crypto, where you could lose your private key and then all your money's gone. That's not needed in this space at all. So it's a very different product. And then we need like real institutions. So Fidelity, if they had a product, that'd be really interesting. Or, you know, but some of the smaller companies that are doing this, like even great companies like BitGo, who you guys are working with, they're just not who these traditional financial institutions work with today. And so there's an educational piece, and they kind of have to jump the shark and get them really engaged. And then, you know, bringing investors in, like right now the word token is a bit poisoned thanks to ICOs, and that really, really hurts the capital formation side. Because people here think crypto, they think Bitcoin, and they see it in a very negative light. And so that hurts the sales of these things. When, as an asset, it's a better, like, it's hard to argue that a piece of paper that you sign is better than, you know, a digital contract that's visible on a public blockchain. Like that, you could lose a piece of paper, right? So, you know, and you always refer to it like email versus snail mail. And so it's the same thing. It's like, you know, is an email better than a mail in the post? Yeah, absolutely. So this will get there, but it's going to take time as it grows.
Yeah, we were talking about, you had mentioned about sort of words matter, that there's a miscommunication between the people who are trying to sell these products and the people who might buy them. Can you talk a little bit about that?
Yeah, I mean, personally, I'd love to see us get rid of the word wallet. I think wallets are the wrong word. They're accounts. You know, people have accounts. That's how they think about investment. And so there's really fundamental things like that we aren't incorporating, and we're trying to bring this traditional crypto nomen, like words, into finance, and the finance guys just don't get it. And guess what? Millennials are not running hundreds of millions of dollars right now. Once they do, those words will make sense, but right now that's not the case.
Sure. Any thoughts on that, Colleen? I have a question around regulation after that for you too.
Yeah. You get the easy ones, right?
No, I was really thinking as these guys were talking about, you know, more of an international conversation around, you know, the different regulators and them getting together and how important that piece is. And I don't know how long that's going to take.
Yeah, I would have to jump in on that one.
Oh, yeah, please.
Jump in, yeah.
So we've been working with some other countries. So there's an announcement recently around some work we've been doing in Thailand. And so we've been working with the regulator in Thailand in our technology stack to help them understand it, help them understand what's possible and what they can do, and they're very engaged with it. They have their own country-specific rules they want to implement now based on understanding the technology. And in a smart contract, you can do it. And so, you know, when you have a proactive country that wants to do this, they can engage, and all the platforms can support those rules very quickly.
Yeah, as far as regulators, I mean, are they, they're dealing with technology too. What kind of a struggle is it for them? What are some of the problems that regulators face when it comes to keeping up with the technology?
Yeah, I just make a real quick comment because we sat down with a number of high-level folks at the SEC and went through it in detail. I found them very pro-innovation, and there was a deep level of technological sophistication, even amongst folks like high-ranking folks in corporate finance or trading and markets, people not just their technical folks, they got it. There was no, we went in on a deep level, and I was just very impressed on a technical level, on a regulatory level, on how they thought it through. They were very open. It was a very good conversation. We had 14 folks from deputy director level up to the deputy director level, and they were very engaged. And we've met with regulators in a number of other countries, often in Germany, folks from the Singapore Monetary Authority and elsewhere. And I'd say on the whole, it's very similar. There are a few pockets here and there in the US and elsewhere of some regulators who sort of, their eyes roll and they light their hair on fire and they run screaming from the room. But that's the exception, not the rule.
Yeah, one thing we tried to do really early on was just be very proactive about reaching out to regulators and being helpful. one of my concerns was, if more guidance is to come out, if more enforcement actions are going to come out, do the regulators actually understand the technological risks? It's very easy to pass guidance that perhaps increases cybersecurity risk. One thing that the money transmission laws did really well, whether it was by accident or on purpose, was it actually forced everyone to use what's called in cybersecurity edge security concepts. So money transmission laws actually helped enhance the security of the infrastructure. So the reason your MetaMask wallet encrypts and decrypts the key in the on the client side in the browser is to so the company won't have to comply with money transmission laws, and at the same time it enhances the security of what they're doing. So we started being very proactive and reaching out to regulators here in the U.S. And doing tech talks, and so that accidentally turned into us becoming almost a consulting arm and having to sort of inform on various topics, and we're very happy to do that. So if you're a regulator and you're listening, always feel free to drop me an email and I'll be happy to swing by.
Any thoughts, Colleen?
No, I would just say from what I have read recently on the SEC's website, I think that they have a new czar of digital digital currency and blockchain. I think I forget the title, but they're very engaged and they're they invite people to come in not just to talk about to educate them, but also if you have a new product and you want to there's a little bit of a push-pull there in terms of do you put your head into the mouth of the lion? I think that, people are concerned if they have maybe a specific innovative product, but I think that they're very engaged and they want to learn the technology, so that makes it more, a better opportunity to really go in and try and educate them.
I'm talking to, I think you, Jamie, I'm not sure, I could have it wrong, but you said that there's more of an appetite from some of these small, so you guys deal with a lot of smaller companies that are attempting to tokenize or what have you. There's more of an appetite for innovation than there is for regulation, or there has been in the past, but you're starting to see a bit of a change. And so I wanted to get you guys to talk about what you're seeing there and how that's looking going forward. Are companies actually understanding regulation better and able to handle it better?
I think so. I mean, I think, last year, it was sort of like phone call after phone call with people trying to get these offerings live so that they could raise, hundreds of millions of dollars overnight. And I think, what's happened is the market's kind of calmed down and people are understanding that actually you can't just write a white paper and raise a big pile of money. You now need to go through a real formal process. And so, that's been the most fundamental shift we've seen. And then, in our business, as you kind of bring customers on, learn and see kind of what really performs and what works, you find kind of the right match of companies for the space. And so that's also been, on our side, understanding who's going to be successful with this and if they've got the right team. Because, as you said, you have to sell these things. And it's not easy to sell securities because there's a lot of great deals out there. And most of them aren't tokenized.
Any other thoughts, guys? So basically, it's really true. People are starting to really comply with regulations, and it's having a positive effect.
Yeah, it went from scorn to skepticism to grudging acceptance. I think we're at the grudging acceptance stage.
Sounds like the stages of grief or something.
I think at first it was a lot of startups in the space that were trying to take advantage of this new form of fundraising. And the blockchain space is probably one of the few spaces where you can't really move fast and break things. And the reason is it's very easy to do illegal things. Just because now there's money, there's securities, it's really easy to move them around. And if you approach it with too much of a growth mindset, it's very easy to do something illegal. And so I think what we've seen this year is more and more mature teams sort of entering the space, and most of our clients are like serial entrepreneurs or career CEOs, and they're generally familiar with deferring to counsel on a lot of these complex matters. And I think the good thing is we're seeing more and more of these types of people entering the market, and so they do bring a more mature perspective. They do ask first, how should I be doing this? What should I be doing? And then going and doing it. So I think that mentality is good for the space.
Any thoughts from you guys on that? As far as a killer app, That's something you and I talked about. What is that rooted in? What would it be rooted in? How could it? I know it's all pure speculation at this point, but something that would come along that would get a lot of liquidity here. What might that look like? Pure speculation.
Yeah.
10 years from now, 3 to 5 years.
So the space is still very new. It was just the summer of 2017 when law firms started figuring out that these were securities, and they started helping companies launch these as securities. And then security tokens sort of came about around that same period of time. I think one thing I keep having to remind people of is that the market for these tokens isn't there yet. And the reason is we still haven't figured out that killer app. We haven't figured out what is actually great about these tokens. And so in order to achieve some sanity there, what I generally tell people is there's 2 things that are fundamentally possible today that weren't before. So one is that these digital securities can now settle 24/7. Traditional markets are 9 to 5. Maybe there's some after-hour trading, but now you can actually settle these things 24/7. The other fundamental paradigm shift is we've sort of almost forced lawyers to figure out global securities laws. And so now we can actually have these sales occur on a much more global basis. And so I think if a killer app does come to fruition at some point, I think it's going to be from a rapid iteration on these 2 concepts, because I think these are the 2 things that are fundamentally different than traditional markets and where the innovation actually does exist.
What about, say, a company isn't able to really find traction or isn't an appropriate product market fit for the United States, but something in India, it might work better in India. One of you guys talked to me about how, I think it may have been you, Josh, about, no, it wasn't you, maybe it was you, Jamie.
Sure.
Yeah, I can't remember this, but it's sort of like there might be the situation in 3 to 5 years where there can be some companies that can make this rapid shift. And already, there's an African wallet, sorry to use the word wallet, there's an African wallet that just didn't work out. Tell me the story of that and how it may exist in the future only go into a different country in the world.
I know what we're talking about.
Yeah.
So I think we were talking about M-Pesa, which is a product in Africa around payments.
Yeah.
And so technology, can develop much more quickly when it's designed really with the user and the capabilities they have in their hands. So M-Pesa was this way to make payments basically using text messages, which is super innovative and way far ahead of kind of what the US or Europe had at that point in time. And actually, in Africa, we've seen a few deals. In fact, one of the countries has approached us about land there, which is really interesting. But again, these are, exploratory conversations that folks are having, and they're trying to understand it. And I do think you can create, it's not really a killer app, it's just a way better product. And like the stuff Josh was talking about, packaging up things is really fantastic, which you can't do today. The ability to move things around and settle quickly is transformative. Like settlement and clearance happening instantly is transformative. The 24/7 markets, isn't probably going to happen. Like T0 actually announced they're only doing 95, kind of bank around numbers. But nonetheless, eventually we'll see that, and we'll see kind of multiple markets. It'll kind of follow the sun and trade it.
All right, sounds good. So what was that I just had? And I just knew what I wanted to ask. If you could wave a magic wand, it was the magic wand question. So we'll start with you, Jamie, and then you guys. If you wave a magic wand, what would you change about the regulatory environment currently?
I'd like to see investor counts go up. I have no problem with the accreditation threshold. I think that makes sense. I think good investments being vetted by folks who spend more time on this make a lot of sense. But the 2,000 investor threshold for an operating business is very small and unrealistic. And so, I'd love to see that go up. I have no problem with the kind of the hold periods that are in force. So.
I would echo that. In Canada, in the US it's called 12G limit. You cannot have more than 1,999 investors per class of equity. Separately on the fund side, if you have accredited investors, you may have limited 99. All that results in your check size, your new investment has to go way up. Right? If you're raising $100 million, you can only have 99 investors, the check size is 1.1. In Canada, for private placements, they all have to be accredited, but there is no limit. You can have any number of investors, which means you can take your price per share, price per token way down. And I just think that's far more effective. The point is, hey, it's a private placement. There's certain limitations on how it trades and only accredited investors can buy. What do you care if it's 2,000 accredited investors or 4,000 accredited investors? Separately, I do think I would have degrees of accreditation. And they try to do that with the crowdfunding regs, but those are so convoluted, they're impossible to deal with. I would have degrees of accreditation and sort of have a sliding scale of what you can do. And then finally, on the crowdfunding regs, I take that $1 million limit and take it way up. I think crowdfunding is really interesting. I think it can be really viable, but at $1 million a pop, that's just not enough money to be meaningful to anybody.
Move it to 5. They didn't do it.
That's right.
If you move it to 5, like, so they changed it, you're up to 5 million.
Yeah, 5 or 10. I mean, I just don't, if you're raising $1 million and people are cutting $5,000 checks and it's meaningful to them personally, what's the difference whether you allow somebody to raise $1 million or $5 million? It just feels like these artificial limits designed to say, yes, we allowed it, but we're gonna make it so unattractive, no one's gonna do it.
Yeah, so if I had a regulatory magic wand, I think first off, I think the U.S. securities laws fundamentally are almost 100 years old, and I think one thing that's really beautiful about our securities laws in particular is we had this technology called Bitcoin and blockchain come about almost out of nowhere. And still, there were some regulations that this new technology could package into, and so I think they've actually served their purpose. And fundamentally, I think securities laws in particular do protect against the wrong mentalities in the space. So I think we found them to actually have the right effect on the market and to actually achieve the goal of protecting investors and making sure the right incentives exist. But if I had a regulatory magic wand, I would give myself a banking and securities license in every country, and that's what I would do.
Why would you do that?
Because then I can launch more products and services in every country and have them be interoperable across all the jurisdictions.
How long before that you don't need a magic wand for that?
I don't think that'll ever happen.
Yeah.
Any thoughts on that too, Colleen?
No, I mean, I think that, you know, I'm a lawyer through and through, so I think that any asymmetry of information is a bad thing, and that, you know, making sure you have a level playing field for people, whether they're investing $10 or, you know, $100,000 is really the most important thing. And I believe that the blockchain probably offers ways to make sure that that information is getting to the right people and it's not being distorted. And so I think that there's sort of a ecosystem there that will help sort of flesh out making sure that the securities laws keep pace, but also taking advantage of the blockchain.
For sure. Okay, in about a minute, we're going to take questions from the audience. So some of you I told to come up with questions, you know who you are. So, and anyone else who has questions too, so get those questions ready. Asset-backed securities. You had mentioned that at the very beginning. You wanted to make sure that we got a question in about that. We talk about what that was about real quick again for me.
So asset-backed securities are commonly, good examples of them are subprime debt. So you take a whole bunch of loans.
That's a bad example.
Subprime debt's a great example. If you can lower the cost of capital for providing debt to subprime borrowers, you lower the interest rates are going to pay. And the fact that people are willing to lend to subprime borrowers is not a bad thing. The reason people are lending to subprime borrowers is because they need the money, right? Just because you're a subprime borrower doesn't mean you don't need a car to go get to your job. And auto loans are probably the biggest source of subprime debt. What is really neat about it is the chance to think about things in a different way. So we've been talking a lot about, in the context of tokenizing equity in startups, as we all know, it's very close to home, or in some VC funds that would give us access to startups. Asset-backed securities, I just think are interesting because it's a totally different space. So if you take, say, the subprime debt, this gets packaged up in tranches of $200, $300 million at a time. Only the largest institutions, pension funds, huge PE funds are buying it. And then it's not really liquid thereafter, they're just waiting for the term to expire on it. The promise of platforms like Securitize and Tokensoft and Harbor is you're democratizing access. You're not democratizing access down to the retail investor, but to a class, several layers down in class investors. If instead of a $300 million tranche of subprime debt, you create $301 million tokens, now all of a sudden you can get a lot of people playing in ways they couldn't before. What happens when you unbundle these into smaller units is more people can invest, lowering the cost of capital, lowering the interest rates for subprime borrowers, or increasing credit availability to more folks. That's a good thing, assuming you're underwriting it correctly. But that's a problem no matter what you do. The other is that by having a secondary market and people getting liquidity, that also increases the value to the investor, lowering the cost of capital. And what it does is it allows people to get involved in it before, to spread out risk, to spread out investment opportunities, and then allow you to bundle things in interesting ways. So you can get really good bets against deteriorating credit quality. So there are credit default swaps available for a lot of bonds. There's not a lot available on some of these asset-backed securities. You can get those available. It is, in my mind, asset-backed securities are a high-finance version of a lot of what we were talking about earlier today. And I think it's interesting because it shows the applicability of what we're doing across different asset classes, different levels of sophistication and size in the financial industry.
All right, let's get a question from the audience then.
I have a question. I love the idea that there's this coming democratization where, someone can buy a, $1 or $20 worth of tokens in real estate investment and now have a real estate investment. Whereas, maybe they can't buy a house in Marin, but they now have an opportunity to have some kind of a real estate investment. And I don't feel like this exists for the average consumer right now. With this democratization, what are some risks that, a person with their $20, token issuance would encounter or should know about?
Yeah, so a couple of things. One is that it's not going to go to $1 or $20.
Yeah.
It's not. But you'll get in at a $10,000 or $20,000 check size in a more targeted fashion than you can before. So today you can get in at $20, $30 a share into a public REIT. It's a huge basket of properties across the entire U.S. You cannot make that bet on a zip code or a neighborhood.
Exactly.
That sort of granular bet you cannot do. The risks are the same ones you get with any investment, only more so. When you invest in a public REIT, it's a public company. They file an S1, they're filing 10Ks, 10Qs, they got Sarbanes-Oxley. There is a huge amount of information out there.
Yeah.
When you start talking private investments, the quantity of information available is much less. The timeliness of it is much less. So you have to know a little bit more about what you're doing or invest in it in a way that mitigates those risks.
Do you think that, do you think, oh, go ahead.
Well, I was just gonna say that it doesn't have to be real estate, right? So a REIT is real estate. The crowdfunding that we talked about earlier, or Reg A+, I guess is really maybe more the dream. No, but that's more of another equity. So you're buying equity, not debt. Some of the other products you can have are debt, and I think probably debt tends to be bigger chunks. I don't know. It just seems like that's, asset-backed securities are traditionally debt, and they're kind of loans that you get from investors against assets, and the cash flows are going to come from those assets. The equity can be structured the same way, and you can get down to smaller denominations, but you have different regulations that apply. So there's a little bit of sort of trying to plug yourself into the right bracket, so to speak. But I think that the tokenization, with the asset-backed mentality, certainly has something to offer, and I think can go down to a level where you're talking about more availability, more democratization.
A good example is think of the risks in investing in startup companies. Most people that can't invest in an LP and a VC fund because they need a $10 million check. Maybe if they can cut a $250,000 check, they're going into an aggregator fund, so they're paying 1 in 10 on top of the 2.5 and 25 the VC fund charges. If they can now go direct into a company or through a tokenized VC fund that's got a much lower fee structure, they have an opportunity to get into things that they couldn't before at a time when companies are staying private much longer and taking much bigger economic real estate. On the other hand, most startups fail, and it's a high-risk investment. It's not for mom and pop, generally. It's a different type of investment. Those accredited investor rules are there for a reason. They may not be structured correctly. We may feel that they're archaic, but people should not be betting their life savings investing in tokenized startups, just like they shouldn't have done it in ICOs. I mean, I knew we hit peak ICO when I started seeing buddies of mine from high school and Facebook maxing out their credit cards, debating whether it's Litecoin or Bitcoin Cash.
Yeah, and by the way, these kind of scams still go on. I had my brother-in-law the other day text me about this amazing new project that he got, information on, and check out this GitHub link. He's a construction guy. He doesn't know anything about this. And so he's trying to vet it with me, and I'm like, bro, this is not for you. But this stuff is still out there, so it's crazy.
I just have a follow-on to the democratization kind of a thing. We know millennials and younger people, people who are right now in high school, are going to be adopting this as investments for themselves going forward when they hit, a degree of maturity, and when the infrastructure and when the technology is more mature. So let's assume.
They're probably going to build it.
So let's assume, we know millennials are going to coasts, they're going to major cities, they're living in major cities, they're not buying houses, they're staying in apartments. But we also know that real estate is one of the best possible investments that you can make. So do any of you have sort of a vision for the future for as these things mature and evolve? How will this go? Because we know for a fact that people they're living in major cities and they're not wanting to invest in the same way that they would have. They're not buying cars, etc. All the trends show that.
Is that what coming
Sure.
Sorry.
Um,
Aren't buying houses now.
Yeah, look, again, it's about finding a really high quality product that will suit that type of investor that they understand. One of the things is a lot of these investment products, particularly the public REITs, are really hard to understand. You don't really know what's in them, you don't really know how it goes, so as an investor, you don't really understand what you're buying. You're kind of just buying this broad stroke, so doing much more specific things I think is really interesting. And overall, I think we'll see that type of product evolve very quickly because real estate folks, whilst they don't adopt technology very quickly, they are really into it when it makes them more money. And so this will definitely work in that way.
I think you'll see them adopt it when they can get into investments that they understand, that correlate with their needs. And it's been adopted by investment advisors or the robo-advisor platforms so that people can understand it. And so, in essence, it's merchandising. You merchandise investments the same way you merchandise clothes or anything else. It's got to be merchandised in a way that's understandable to folks, that one, actually meets their needs, and two, that they perceive to meet their needs. But I think it's interesting, even before blockchain, there was a startup called Neighborly here in San Francisco. They're all about democratizing access to muni bonds. And essentially what they do is they are selling direct to investor muni bonds in smaller check sizes in the neighborhood. So that way, your local school is raising a $2 million muni bond to finance renovations. Folks in the neighborhood are investing in their school, right? They feel that you get a number of things. One is the school is lower cost of capital, more people coming in. Another is you help to build political support for that school because now I'm an investor in an ownership mindset. You can do the same thing with tokenizing equity in startups, sell that equity to partners in the ecosystem, sell it if you're an esports team, sell it to fans so they have an ownership mindset. We're talking to a really interesting company. They own a bunch of real estate in a downtown business district. And already there's sort of talk of gentrification or being pushed out. So their idea is take a minority interest in these buildings, tokenize it in this single asset REIT format that we're using in the investment we have live now, and then sell that at a reduced price, essentially their cost basis, to the union pensions that are involved in building the place, to merchants, to tenants, donate some to local nonprofits. In other words, us as startups, we constantly grant employees stock options to create an ownership mindset and align incentives. Do the same thing with ownership equity in your real estate. Do the same thing with equity in your company, with the wider ecosystem of folks that you work with. It's creating aligned incentives and ownership mentality.
You could talk a little bit more about that. Why is it so great? It creates a line in the sand, more of an ownership mentality. Talk a little bit more.
So I'm a tenant in the building, right? So Landlord's going through, making improvements to the building, rent's gonna go up, the whole neighborhood's improving, so rent's going up everywhere. I'm a tenant, I have the ability to buy into equity, so the landlord's gonna raise funds. I'm contributing to the overall economic value, because I'm a great tenant, desirable tenant, and I'm paying my rent, right? The same way in which, if I'm a merchant in the neighborhood, right, so I own my little convenience store that I had for a while. Now I've got someone who's redeveloping the area, concerned about gentrification pushing you out. Now the person who's doing the redevelopment sells me equity in the development they're doing, they're selling it at their cost basis. I already have a paper gain. I have a chance to invest in my neighborhood and an economic stake and improve my neighborhood rather than feeling I'm being penalized by it, by gentrification. The same idea is to create a line of incentives. We create increased economic value in this downtown business neighborhood. Let's give everybody a stake and increase in that value. Same way when you give employees stock options so that they work their ever-living butts off to make a successful company. Let's do the same thing in a wider societal context.
More questions from the audience? Go for it.
Is there a need for a universal like token standard that's adopted by the majority of the exchanges and issuance platforms in order for the ecosystem to really take off?
Who wants to tackle that?
Yeah, I think so. If we look at like the history of exchanges in the space, Bitcoin exchanges, one thing that's interesting about them is every company that is selling Bitcoin is built on the same infrastructure. It's all on top of the Bitcoin network, and they're all using Bitcoin wallets to service their clients. And I think as this technology shifts to the security token space, the properties are the same because the technology is the same. And what we've seen with Ethereum is the same thing. All of these exchanges are built on top of Ethereum, and because they're plugged into one shared ledger, now it's easier for them to transfer trades between each other, for people to move money across different countries, different exchanges. And I think in this space maybe the standards will matter less. But just the concept of shared infrastructure that everyone can plug into, I think is a really big deal, because that's something that didn't really exist before that's now possible.
I'd say we have it. We have ERC20. That's what you need. That's what you need to interact with Dharma, with Blockboard, with DYDX, with SET. Harbor issues ERC20 standard tokens, and that is the standard. There's a lot of other proposed standards out there. There is a possibility of different standards to advance the ball, but I think it's premature. Normally, industry tries a wide variety of approaches, people test them, and then things start to coalesce on a couple of different options, and then everyone gets together to set a standard. Setting a standard before any sort of real adoption, I think is getting the cart before the horse. We need to have real experience to know what works, what doesn't, what's valuable. In terms of having interoperability, wallets, exchanges, everything else, we've got to do this ERC20.
Yeah, I agree. I mean, look, we've got a bunch of stuff trading, and as it's been out there, we've had to make adjustments because the rules have gotten a little bit clearer, some things have changed, and if you had to go back to the standards committee to get something approved, it just wouldn't work. And so, like, as we're building this, it's like flying the plane while you build it type of thing, right? And so, it's just not ready. We're not ready yet, and every time somebody introduces a new one, it's like, oh, great, another standard. It's like, I think that there's, Carlos said the other day, there's more security token standards than there are issued security tokens.
All right. We're down to our last minute. Any other questions in the back?
I was wondering, so how are stable coins and such classified? Are they considered securities, or like what space would they fall in?
It depends on what the stablecoin does, because there's some ideas that people have where the stablecoin is doing too much. But let's say it's just $1 in the bank and $1 in the token, and so generally that and it depends on more factors. But generally that's money transmission. You're holding funds somewhere on behalf of someone else. So anytime you have the ability to move or stop someone else's funds, you fall under money services businesses laws and need to be a money transmitter or a trust. But there's other ways to do that as well.
All right, let's get a nice round of applause for our panel. And let's also have a nice round of applause for the person who planned and executed this whole event, Pamela.
We all want to thank you very much.